Welcome back to the deep dive. Today we're tackling a topic that, let's be honest, causes a lot of anxiety for millions: credit scores.
It really does.
Yeah, whether you're just starting your financial life, trying to build that file from scratch, or maybe you're actively rebuilding after, a bit of a rough patch,
hmm
the amount of information out there can just feel overwhelming. It seems like everyone's got a different magic bullet, but the actual rules often kind of hidden.
That's absolutely right. And navigating credit is tricky because the best path forward really depends on your specific starting point.
Okay, so our mission for this deep dive is pretty straightforward. Give you a clear, structured shortcut. We want to lay out the essential, evidence-based steps you actually need to take to move the needle on your score.
Right.
We're going straight to the sources, distilling the core mechanics, because honestly, understanding how scores are calculated, that's the only baseline that truly matters. Exactly. So we're going to frame this around basically two main scenarios. Either you're building that foundational file like for the very first time, or you're actively trying to improve and rebuild one.
Yep, those are the big two.
And our sources map out about 5 general steps that apply pretty much across the board. Covers everything from laying the groundwork to mastering the ongoing maintenance. Okay, let's unpack this. Let's start right at the beginning. Step 1, building your credit file. I mean, if the credit bureaus don't have any accounts reporting activity for you,
You're essentially invisible as a borrower.
right, no track record. So your first job is opening accounts that consistently report. And thankfully, most, major lenders and card issuers do report to all 3 main bureaus.
And the type of account you open really hinges on where you're starting from your score or maybe even lack of one.
Okay.
So if you're a complete beginner or perhaps someone trying to recover from some significant credit damage,
Right.
getting a traditional unsecured card, probably not going to happen right away.
Yeah, that makes sense. Which leads us to 2 really essential starting tools: secured credit cards and credit builder loans. Okay, break those down. What's the difference? I think a lot of people hear secured card and just think it's like a debit card, but it's actually reporting credit activity, right?
Precisely. That's the key difference.
Mm.
With a secured card, you provide a cash deposit, let's say $500. That deposit usually becomes your credit limit.
Got it.
You use the card just like a regular credit card, make your payments, and here's the important part: that activity gets reported to the bureaus. The lender's risk is super low because they're holding your cash as collateral.
Ah, okay.
But you get the huge benefit of proving you can handle revolving debt responsibly.
And credit builder loans, they work differently.
Yeah, they kind of flip the script.
Yeah.
You take out a loan, but instead of getting the cash up front, the lender holds the money, maybe in an escrow account or a CD.
Okay.
You then make regular installment payments, principal and interest, over a set time. Only after you've paid it all off do you actually get the money.
So it forces you to save while building credit.
Exactly.
Yeah.
It builds payment discipline and establishes a positive history with installment debt, which is different from revolving debt like credit cards.
Mm.
Now, if you already have a pretty good score established,
Yeah.
you could probably skip those steps and go straight for a good rewards card, ideally one with no annual fee. And then, crucially, keep the utilization low, which, don't worry, we'll definitely get into later.
Okay, good. Now, I'm glad you brought up alternatives because I know a lot of people try the authorized user strategy, like getting added to a spouse's card or a parent's card. That sounds almost too easy.
It can seem that way.
Is there any way that could actually backfire on me, the authorized user?
That's a critical question, and yes, absolutely, it can backfire. While being an authorized user can give your file an instant boost by basically inheriting the primary user's good history,
Mm-hmm.
their payment history,
Yeah.
and importantly, their credit utilization ratio also get reflected on your report.
Mm-hmm.
So if that primary user suddenly runs up a huge balance, maxes out the card, or worse, starts missing payments.
My score takes a hit too, even though I'm not responsible for the debt.
Exactly. Your score suffers the consequences, even though legally you don't owe the money. So you have to choose that primary user very, very carefully, make sure they're responsible.
Okay, that's a really important warning. Now, here's where things get really interesting, especially for people starting with like almost no file at all. The sources point to a major shift happening in the industry, incorporating non-traditional data.
Right, expanding what counts as credit history.
So the basic first step is just getting a file created, right?
Mm.
Often through free services that help you see your report, like maybe Experian Go creating one for you if you don't have one.
Yes, establishing that initial file is key. And once it exists, there are now proactive ways to add positive history that, never used to count before.
Okay. This highlights a really significant trend. Moving beyond just traditional debt data, we're talking about tools, like Experian Boost, for instance. Experian Boost, what does that do?
It allows you to connect things like your positive utility payment history, your cell phone bill payments, even streaming services.
Wait, really? Like Netflix?
Yeah, potentially. You link your bank account, identify those recurring payments, and if you have a good track record of paying them on time, that positive data can be added directly to your Experian credit report.
So traditionally, paying say, my water bill or my phone bill on time did absolutely nothing for my credit score.
Correct. Invisible to the scoring models.
But now, if I choose to use a service like this, these on-time payments for regular household expenses can actually become positive factors.
Exactly. Normally, these non-debt payments, they just aren't seen by FICO scoring models. But using these tools means they can be incorporated specifically into your Experian FICO scores. And for someone with a thin file or maybe a score that's just hovering below a good threshold, adding this kind of reliable positive payment history, it can be genuinely transformative. It's a really positive development for consumers, I think. That really is a massive change, recognizing responsible behavior beyond just loan payments. Okay, let's shift gears now to the fundamental behaviors, the bedrock of credit scoring, the maintenance steps. Let's focus on payment history and utilization, starting with step 2, payment history. You said this is the cornerstone. This is the bedrock. Absolutely. Hands down the most important factor in calculating your score. But here's something many people overlook, the critical cutoff.
Okay.
It's payments that are 30 days or more late that get reported to the bureaus, and those are the ones that inflict serious damage.
30 days. Not 1 day, not 10 days.
Right. The scoring models are specifically looking for that lapse of more than 29 days. Missing a due date by a few days, usually forgivable, though you might get a late fee from the lender. But crossing that 30-day threshold, that's when the negative reporting starts, and it can cascade.
Okay, so the absolute must-do tip here is setting up automatic payments for at least the minimum amount due. Non-negotiable.
Absolutely. Automation is your best friend against just forgetting. But like you said, set it for the minimum due, not necessarily the full balance, unless you are incredibly confident about your bank balance.
Right, because an auto pay causing an overdraft, a
Yeah.
whole different kind of expensive headache.
Exactly. And here's another crucial point that often gets missed, even accounts that don't typically show up on your credit report. Like what?
Things like maybe an old medical bill, a gym membership you stopped paying, some subscription services. If those go unpaid and get sold or sent to a collection agency.
Then they show up. Then they absolutely can show up as a negative collection account, and they will hurt your scores. So they don't help you when you pay on time, but they can definitely harm you if they go into default. That's critical to understand, that asymmetry. Okay, now let's look at step 3, catching up. Let's say you are behind on an account. Is there still value in bringing it current, even though you know that initial late payment mark is going to stay on your report for potentially up to 7 years? Oh, the value is immense, huge. Bringing accounts current stops 2 really bad things immediately.
Okay.
First, it prevents future negative marks from being added to your history month after month. That 30-day late becomes a 60-day late, then 90. Bringing current stops that progression.
Got it. And second,
It stops those escalating late fees and penalty interest rates that lenders often tack on. Now, if you're really struggling, maybe juggling multiple overdue credit cards, talking to a reputable nonprofit credit counselor is a very, very good idea.
and they might suggest something like a debt management plan or DMP. How does a DMP actually work? Why is that helpful for getting back on track?
Right, a DMP. It's essentially a consolidated repayment plan. The credit counseling agency works directly with your creditors. They negotiate on your behalf, aiming to potentially lower your interest rates, maybe waive some fees, and consolidate your payments into one more manageable monthly payment to the agency.
Okay, so it simplifies things.
It simplifies things for you, yes.
Okay.
And crucially, as part of this agreement, the credit card companies often agree to re-age the accounts. That means they mark them as current again, stopping those damaging monthly late payment reports.
Right.
It's a structured path back to financial stability, but it definitely requires commitment on your part to make those payments.
Right. Okay, moving to step 4, the other really big pillar of credit scoring. Pay down revolving account balances. Now, this is specifically about credit cards and lines of credit, right? Not installment loans like mortgages or car loans.
Yeah, exactly.
Revolving debt. We hear the term credit utilization rate thrown around constantly. Let's define that simply.
Yeah, please do. So credit utilization is just the ratio of what you currently owe on your revolving accounts compared to your total available credit limit across those accounts.
Okay.
Think of your total credit limit like the total cargo capacity of a ship. If you're carrying a huge load of debt relative to that capacity, meaning your balances are high compared to your limits, that sends up a big red flag to the scoring models.
A risk signal.
A major risk signal. It suggests you might be overextended or heavily reliant on credit just to get by.
Can you give us a quick example with numbers?
Sure. Let's say you have one credit card with a $10,000 limit, and your current balance on that card is $9,000. Your utilization on that card is 90%.
Okay, that sounds high.
It is very high in the eyes of scoring models.
Yeah.
They see that 90% and interpret it as high risk. So to significantly improve your scores, you have to get that ratio down. You need to maintain low balances relative to your limits.
How low are we talking? Is there a target? Well, generally under 30% is considered okay, under 10% is considered good, but here's the real insight. People who consistently have the highest, the most excellent credit scores, they tend to keep their overall credit utilization ratio down in the low single digits. Wow. Single digits, like below 10%, even below 5%.
Ideally, yes, below 10% is great, but pushing towards, say, 3% or 5% can make a real difference at the top end. That's the ultimate goal.
That is such a specific and, frankly, impactful piece of advice. Just focusing on lowering that utilization percentage from, I don't know, 50% down to maybe 5%, that alone can cause huge jumps in your score, even if everything else stays the same.
It's one of the fastest ways to see improvement, assuming your payment history is clean.
Yeah.
Okay, so we've covered the big maintenance items. Now let's look at step 5, limiting applications for new credit. We said earlier that opening accounts helps build credit initially,
Right.
but applying for too much credit too often can actually work against you. How does that happen? It impacts your scores in a couple of ways. First, every time you formally apply for credit, the lender usually pulls your report, generating what's called a hard inquiry.
Okay, hard inquiry. Why does that matter? Is it a big deal?
Well, a hard inquiry happens specifically because you initiated an application for new credit. It signals to the scoring models that you're actively seeking more debt, which statistically slightly increases your risk profile in the short term.
Slightly.
Yeah, one hard inquiry usually only dings your score by a few points, and the impact fades relatively quickly, usually within a year, though it stays on your report for 2. But if you have multiple hard inquiries, especially close together,
They add up. They can compound that small negative effect. The second impact is a bit more subtle. It relates to the average age of your accounts.
Oh, okay. How does that work? Scoring models like to see a long, stable credit history. When you open a brand new account, its age is 0. This immediately lowers the average age of all your accounts combined. And while length of credit history isn't the most important factor, like payment history or utilization, it still plays a role. Too many new accounts quickly can drag down that average age.
Okay, that makes sense. But is there ever a time when applying frequently is actually okay? I hear people talk about rate shopping for big loans.
Yes. And this is a critical exception everyone should know about. Rate shopping for specific kinds of installment loans, we're mainly talking mortgages, auto loans, sometimes student loans.
Okay.
The credit scoring models are smart enough now to recognize this behavior. They understand that you're comparing offers from different lenders for the same single loan, which is financially responsible. It's not like you're trying to open 5 new credit cards all at once.
So they treat those inquiries differently.
Exactly. They often deduplicate or ignore multiple inquiries for the same loan type if they all happen within a concentrated time frame, usually something like 14 days, maybe up to 45 days, depending on the specific scoring model. So you can shop around for the best rate on a mortgage or car loan without wrecking your score.
That's really good to know. Okay, so pulling all this together, what does this mean for someone who genuinely needs to rebuild? Maybe they've had some significant damage, like multiple accounts 90 days late, or maybe even a foreclosure or repossession. What's a realistic timeline for recovery?
Yeah, that's the tough question. And the honest answer is there's no single set timeline. It really depends on the severity of the negative information on your report and, crucially, what positive steps you take afterwards. So a single missed payment is different from, say, a bankruptcy. Vastly different. A single 30-day late payment. If you bring the account current immediately and keep everything else perfect, the impact will lessen noticeably over time, maybe becoming minor after a couple of years. But if you have multiple accounts with serious delinquencies, or major events like charge-offs, collections, foreclosure, bankruptcy, recovery is going to take years, not months.
But time is ultimately on your side, right? these negative marks don't haunt you forever.
Time is absolutely your ally here. And the impact of negative items does lessen as they get older, even before they fall off completely. Most negative information, late payments, collections, charge-offs, Chapter 13 bankruptcy, is required to be removed from your report after 7 years.
7 years. Is that from when the account closed?
Good question. Usually that 7-year clock starts ticking from the date of the first delinquency. So the
Okay.
date you first missed the payment that eventually led to the account going bad, like a charge-off. Not necessarily the day the account was finally closed or sent to collections. That distinction can sometimes shave off important months.
Okay. Any exceptions to the 7 years?
The main one is Chapter 7 bankruptcies. Those can legally stay on your report for up to 10 years from the filing date.
10 years. Okay. Before we wrap up, we really need to touch on a warning about some third-party services out there. The ones that often seem to prey on people who are desperate to fix their credit quickly.
Yes, absolutely crucial warning. You need to be extremely cautious of any service promising a quick fix or guaranteeing score increases. First, let's talk credit repair companies.
Okay, what's
Okay.
the issue there?
They often charge pretty hefty fees to supposedly clean up or fix your credit report. The reality is they generally can't do anything legally that you cannot do yourself for free.
Like disputing errors.
Exactly. You have the right under the Fair Credit Reporting Act to dispute inaccurate or incomplete information directly with the credit bureaus yourself at no cost. These companies often just flood the bureaus with disputes, hoping something sticks, but they have no magic wand to remove legitimate negative information.
Got it. What about debt settlement companies? They sound helpful, but I've heard warnings.
You need to be very wary of debt settlement companies. Their typical strategy involves telling you to stop making payments to your creditors altogether.
Stop paying. But wouldn't that trash your credit?
Precisely. While you're not paying, your accounts are racking up late fees, penalty interest, and devastating late payment marks on your credit report. The idea is that eventually, the creditor might become desperate enough to accept a lump sum settlement for less than the full amount owed, which the settlement company negotiates for you, taking a hefty fee for themselves, of course.
That sounds incredibly risky.
It is. This strategy can cause massive, immediate damage to your credit score, potentially for years. It might even lead to your creditors suing you. And often, after their fees are factored in, you might not even save much money compared to the original debt. If you're drowning in debt, stick to reputable nonprofit credit counseling agencies we mentioned earlier. They offer constructive solutions like DMPs, not destructive ones. Okay, so just to summarize the absolute most critical takeaways from our deep dive today. Number 1, your relentless focus has got to be on making all your payments on time. Never, ever cross that 30-day late threshold if you can possibly help it.
Right, payment history is king.
Manage that revolving credit utilization like a hawk. Keep those balances low compared to your limits. Aim for the low single digits if you really want top scores.
Low single digits. Got it. And number 3, be proactive. Look for ways to add positive data to your file, especially if it's thin, whether that's using secured cards or loans responsibly, or maybe leveraging tools that incorporate your positive non-traditional payment history where available, like with Experian Boost. That clarity on those 3 pillars, payment history, utilization, and sort of file depth or positive data, that's exactly what people need.
Fantastic summary.
Yeah.
Okay, now here's one final provocative thought for you, our listener, to chew on. It builds on that exception we talked about for rate shopping. Since we know that a hard inquiry is usually just a minor temporary factor in your overall score, think strategically about when it might be absolutely worth accepting that small temporary dip.
Yeah.
When does it make sense to take that tiny hit to secure a really significant long-term financial advantage? Like maybe locking in a quarter point or even an eighth point better interest rate on a 30-year mortgage. That could save you thousands over the life of the loan.
That's a great point. Yeah, sometimes consciously leveraging a minor scoring factor to gain massive control over a major long-term financial outcome. Well, sometimes that's the only really smart play, something to think about. Until next time.